Now, another thing that I still am having a little trouble understanding is how Wall Street got involved here. Now, the banks have these loans. Now, Freddie and Fannie don't actually make the loans.
They do make some loans.
Oh, they do. Okay.
They do both. They both make loans and they guarantee loans.
Okay.
And so when they guarantee a loan, then it means that people are more likely to be willing to buy that loan because not only is some person going to repay it, but also then Fannie Mae or Freddie Mac stand behind it.
So if the person who took out the loan defaults, Fannie and Freddie will pick it up.
We'll pick it up. They'll
Okay.
make the payments.
So those loans were bought by banks?
Well, the loans were typically made by banks.
Okay.
And then the banks could turn around and give them guaranteed or sell them off to Fannie or Freddie, or once guaranteed, sell them to other people.
Now that, I think, is sort of how it got into Wall Street. Is that correct? Is that the banks were selling these suspect mortgages to other financial institutions who wrapped them into yet another financial instrument?
Oh, well, that's how Wall Street took off from there. I mean, yes, it started with banks making these loans, which were picked up by Fannie and Freddie, in effect. Mm-hmm. And you mentioned how large that is. Those two institutions have $5.5 trillion worth of direct loans and guarantees. $5.5 trillion, which the U.S. government has now picked up as a direct obligation. So as a country, the federal government now owes at least $11 trillion that it recognizes as its debts.
And when we had this real dramatic situation a couple weeks ago when they were talking about just how huge the $700 billion, which of course it was, but $700 billion compared to the $5.5 trillion problem that started it all, how does that compare?
Well, it's part of the same issue. In other words, how deep is the hole?
Right.
And again, when you have inappropriate lending, you have the risks. Both the borrowers can't pay and the institutions that are taking the losses get overwhelmed. But where you started on was Wall Street taking off.
Wrapping them up, yeah.
And it was a political environment that started this. You have these quasi-governmental institutions using an implicit guarantee of the Treasury, making and supporting loans that were in fact quite risky, in fact hugely risky compared to the capital they had to deal with them. Now, what Wall Street did was they observed, well, look at this is going well, and there's an appetite around the world for higher yields, and this goes back to the aftermath of the technology bubble and its crash in March of 2000. And in response to that, to avoid a possible recession, we had the Federal Reserve lower interest rates to historic lows. Suddenly you had the ability to borrow money very cheaply and to invest in other things. Mm-hmm. Well, that caused the intermediaries to want to borrow and invest in these things, and it caused other investors like pension funds to want higher yields.
Okay, now intermediaries are?
Oh, like a Merrill Lynch.
Okay.
Somebody who would say, look, we'll put together a pool of mortgages, say 1,000 mortgages. Mm-hmm. We'll put these together and we'll sell them to investors. We'll sell bonds secured by these mortgages to investors. And they got these bonds in little tranches. Because, when you take a bunch of subprime mortgages, you take a bunch of very weak, high-risk mortgages. Now,
so who would want to buy those?
Well, that's a good question. Who would want to buy that? But what if you get really inventive and you say, well, we're going to cut a bunch of different bonds off this. We'll take some that will be junior, that is, they're lower in priority to others. And let's just say 2 bonds. They often did many layers, but just 2. One would be a very risky bond because it would take all the losses until it was exhausted. Suppose you sold 10% of the bonds were these real risky type, and the other 90% were senior to those. In other words, wouldn't lose a penny until the 10% had lost all its money.
Well, who would want to buy those 10%?
Well, that's interesting. People who wanted very high yield, who were very risk tolerant,
okay.
And the investment banks themselves. Because, who would buy that? And so very often they would keep them themselves, collecting a fee for putting the whole thing together, selling the 90% off, and they got that done by getting rating agencies to give a AAA rating, the very highest, equivalent to the rating the U.S. government has, to these bonds that were being supported by subprime mortgages.
Now, so you're saying that the toxic loans were getting AAA ratings?
No, the really toxic part were not rated AAA.
What were they rated?
Well, they were often unrated completely.
I see.
because there was no purpose in asking for a rating that would be that low.
Mm-hmm.
But the real key was they were getting bonds secured by all these low-value, high-risk mortgages rated very highly.
And how did that happen? Because I would think the investment, I as someone who is not an investment advisor, I don't keep track of these things. I have to rely on a rating company to tell me what something is worth. How is it possible that they could have rated these AAA when they were in fact so suspect?
Well, I think there's a really good question. How could, and you don't have to have a lot of training to understand how bad this was. Because when you think about it, a little common sense is important. How can you take very low quality mortgages and create a AAA piece of paper from them? Very good question. The answer was you couldn't. But the rating agencies employed some backward-looking models, looking at the past few years, which were very good years in the United States, and saying, well, the risk of default is very low because house prices keep going up. Mm-hmm. And so if house prices keep going up, even if the borrower can't make the payments, doesn't matter so much. You just sell the house.
Right, get your money back.
The borrower makes a profit, mm-hmm. and all the loans paid off. But
okay.
what happens if house prices fall?
Right.
And what you can see is here you have a bunch of supposedly intelligent people using backward-looking models to say, the risk is very low, therefore we can rate these bonds AAA. And the size of that mistake was apparent when some of those AAA ratings went to default in 1 week. Now, normally in bond rating, when a company, for example, that's rated AAA begins to get in trouble, it goes to AA,
right.
single A. It's still an investment grade bond. These went from AAA to junk overnight, which is to say they were completely wrongly rated to begin with. All that had to happen was a little adjustment, and the adjustment that kicked it off was a stability and then a falling in house prices.
Right.
And then it became obvious, if house prices weren't rising, that there was no way out for a lot of these mortgages. And they would go down, and they would begin to spread this problem through all of industry.
Right.
And I'll tell you one more thing, which makes it even worse. When you think about it, how could you have a company like Merrill Lynch or Lehman Brothers, how could you capitalize it with 30 times as much debt as you had capital when you were dealing in such risky products? Well, the way you did it was you entered into contracts with other people to take off some of that risk.
And who were those other people?
Well, they were other people like Goldman Sachs, other similar institutions, and they would do all sorts of things back and forth with themselves between the banks and these investment banks. They'd each offset each other's risks. So if you were carrying some bad mortgages, let's say you had some of these really toxic papers, mm-hmm. you would get somebody else to guarantee you against loss in those. Like AIG. You've heard of the insurance company,
yes.
AIG?
Yes.
Well, they started to write guarantees against these securities. Well, AIG was leveraged 100 to 1. Now, how many of these could go bad before AIG would fail?
Well, I have a question. I thought insurance companies did have regulations as to how, obviously you're not going to buy a new insurance company if you know they can't cover the losses that they've insured.
Well, AIG writes a lot. It's actually a very large, well-respected insurance company in many areas.
Okay.
But one of the areas that was new and unregulated was this thing of guaranteeing all these securities. Mm-hmm. In other words, the writing of automobile insurance and life insurance is regulated by the states. And so anybody who is writing that insurance is subject to regulation by the state insurance agencies, and they look at the kind of risks that are being taken.
Okay, so if they were over-leveraged, the state would say you've got to stop.
That's right.
Okay.
But the other side of AIG, which unbelievably became half of their portfolio, the unregulated
In what
part,
period of time?
Well, over a period of years while this whole thing was happening.
Like 5 years?
Yeah,
7 years?
The last 2 or 3 years is
really?
when
That's
AIG
short.
really picked it up.
Okay.
Because the paper that was being issued was riskier and riskier, and so more and more people wanted the guarantee of an insurance company, a AAA-rated insurance company, which AIG used to be.